Uh, Imagine waking up to, actual ballistic missile threat alerts lighting up your phone, right, while you're simultaneously watching your tech portfolio violently shed 600 points.
Yeah, quite the morning.
Right. Today, geopolitics and algorithmic trading they totally collided in real time. And the fallout was honestly completely counterintuitive.
It really was.
Welcome to our deep dive. Today, we are tearing into a stack of sources covering an absolutely chaotic Tuesday, August 18, 2026. We're going to look at the explosive developments in the Middle East, a sudden and severe collapse in U.S. housing starts, and decode what a pretty stark warning from Home Depot actually means for your wallet.
It is the absolute definition of diagnostic muddy waters today, honestly. We saw this intense tech-led equity liquidation collide directly with actual ballistic missiles in Dubai.
Yeah.
And, the way the market reacted, or in some cases completely failed to react, it tells us this massive story about where the global economy is actually heading.
I am so eager to unpack all of this. But before we get into the weeds, just a quick reminder that this deep dive is for market context and discussion only. We are here to help you understand the forces moving the tape, but this is not personal investment advice or recommendation to buy or sell any security.
Exactly. Always keep your own risk profile and time horizon in mind.
Okay, so what set the stage before the U.S. session? Because to understand the sheer panic we saw during U.S. trading hours today, we actually have to rewind a bit.
Right, to the macro landscape we inherited from Monday, August 17th.
Yeah, exactly. The market was already trying to digest some massive structural shifts beneath the surface. Like, for example, we had the news that Nvidia secured a staggering 4.25 gigawatt power lease for an OpenAI campus out in Ohio.
Which is just a mind-bending amount of electricity.
It's absurd.
Right. I mean, to put that in perspective, 1 gigawatt can power roughly 750,000 homes. So you're looking at the power equivalent of a major metropolitan city purely to run data centers. It perfectly illustrates that massive theme of AI power demand as a physical grid bottleneck. The infrastructure required for artificial intelligence is no longer just about printing silicon chips. I mean, it is slamming into the physical limits of our public utilities.
Right. The capital expenditure required is just astronomical. And while the market was chewing on that physical reality, the interest rate backdrop was quietly becoming incredibly hostile.
Yeah, it was.
We saw a distinctly hawkish shift from Wells Fargo, who released a projection calling for a 25 basis point Fed rate hike in 2026.
See, that projection is the silent killer here. We talk a lot about how risk-free yields act as gravity-compressing equity multiples. When a major bank projects that the baseline cost of capital is going to go up or even just stay elevated way longer than expected,
right,
the sky-high valuations of these tech companies become mathematically harder to justify. If you can get a guaranteed elevated yield from a government bond, you're going to demand a much higher return to risk your money on a tech stock.
Makes sense. So if you are an investor, you've got this super fragile setup, right? Sky-high tech valuations teetering under the threat of higher for longer interest rates. And then
you throw a match into it.
Exactly. You throw a geopolitical match right into the powder keg. Let's look at the tension that was brewing globally right before Tuesday's opening bell. Late Monday night at exactly 10:57 p.m. Eastern Time, reports emerged that multiple outbound commercial ships had been struck by projectiles in the Strait of Hormuz.
Yeah, it was huge.
And we then saw President Trump confirm that the U.S. naval blockade in the region remains in full effect.
And that tension was definitely not isolated to the Gulf either.
Right.
Fast forward to 6:47 a.m. Eastern Time on Tuesday morning, and we have direct friction between NATO allies. Israeli fighter jets actually struck a Syrian military airbase near Aleppo. Yeah, and the stated goal of that strike was to prevent Turkish troop deployments in the area. Turkey immediately responded with very strong condemnation. So, you have critical global shipping lanes actively under fire and direct military posturing involving a NATO member.
All happening right as Wall Street traders are, commuting to their desks.
Exactly.
But, I have to pause and push back on the market's reaction to all of this, though. Because if we look at this through the lens of geopolitical escalation as game theory brinkmanship, the numbers they don't add up.
How do you mean?
Well, if the Middle East is truly on the brink of an all-out supply shock that's going to choke off the global economy, why did WTI crude actually fall today? I mean, it closed down at $84.44. Is the oil market just calling a massive geopolitical bluff here?
It's a brilliant question, and the disconnect between the terrifying headlines and the physical commodity tape is exactly what you should be focused on.
Right.
The oil market often treats these military escalations as extreme brinkmanship, right? Like a high-stakes negotiation tactic rather than the inevitable start of World War III. Supply is currently restricted through the blockade, yes. But oil traders might be pricing in the reality that neither side actually wants a total prolonged closure of the strait.
Because it would ruin everyone.
Exactly. The economic blowback, the sheer destruction of demand for all players is simply too severe.
It's a terrifying game of chicken.
Yeah.
So, okay, let's wrap this up. We have this massive pressure cooking overnight with the rate hike fears, the grid bottlenecks, and multiple missile strikes, all setting up for a wild Tuesday. Let's take a quick break and dive into the actual session.
Sounds good.
All right, welcome back.
Yeah.
So what moved markets during U.S. trading hours? Let me just lay out the stark numbers for you, because the price action was nothing short of brutal today. Nasdaq 100 futures plummeted over 600 points.
Just a total bloodbath.
Yeah, they fell from an intraday high of 30,121.25 all the way down to a low of 29,514.56. And they closed near the dead lows at 29,557.6. The cash S&P 500 closed down at 7,691.76. But here is the real shocker that had everyone's head spinning.
The gold liquidation.
Yes. Gold suffered a massive simultaneous liquidation. It collapsed from an intraday peak of $4,493.10 to settle at $4,388.80. That is a stunning $100 plunge in the ultimate safe haven asset.
And seeing gold liquidate right alongside tech is always a massive red flag for the overall system. Usually, if tech sells off purely on fear or valuation concerns, gold catches a bid.
Right, people flee to safety.
Exactly. Investors sell their risky tech stocks and park that cash in gold. When equities and safe havens both drop out of the sky simultaneously, it tells you investors aren't just shifting assets, they're indiscriminately raising cash, period.
Just a mad scramble.
Yeah, they're likely facing margin calls or liquidity crunches and selling whatever they can, not what they want to.
And the headline that everyone in the financial media pointed to as the trigger it hit at 10:05 a.m. Eastern Time, the Dubai missile crisis. Residents in Dubai literally received incoming missile threat alerts on their phones.
Terrifying.
The UAE Defense Ministry detected 2 ballistic missiles launched from Iran targeting marine traffic, resulting in powerful explosions in Jebel Ali. And in a major and immediate escalation, the UAE Foreign Ministry completely halted all trade and financial transactions with Iran.
It's an incredibly volatile situation. I mean, a direct missile threat to a major global financial and logistics hub like Dubai is just a textbook black swan event.
But, the chaos wasn't just overseas. We had massive heavy pressures right here on the domestic and trade fronts, too. At 1:27 p.m. Eastern Time, high-stakes trade talks were actively underway as U.S. and Canadian negotiators raced against the clock to avert a midnight deadline.
The tariffs.
Yeah, a deadline that would trigger 50% tariffs on Canadian goods. That is just a perfect example of supply chain disruption as a multi-channel margin tax. If you're a manufacturer and it suddenly costs 50% more to move raw materials or parts across the northern border,
your corporate profit margins get absolutely obliterated overnight.
Exactly.
And while to make matters worse, we have to look at the domestic economic data that quietly dropped earlier in the morning before the missiles even started flying.
Oh, the housing data.
Right. At 8:02 a.m. Eastern Time, the data showed that July U.S. housing starts collapsed 12.4%. That's an annualized pace of 1.239 million. That horrific housing number completely overshadowed a very modest 0.2% rise in industrial production that trickled in at 9:15 a.m. ET.
I am looking at all these pieces, and I am honestly struggling to reconcile the narrative that the financial news networks were screaming all afternoon.
Oh, that the missiles caused the sell-off.
Yeah. They were saying that Dubai missiles directly caused this massive 600-point tech and $100 gold sell-off. It's a clean story, right? Missiles fly, markets tank, but the underlying mechanics just don't support it. I look at the VIX, the ultimate fear gauge for Wall Street. If we're on the brink of a catastrophic regional war that's going to shut down Dubai, the VIX should be spiking into the 20s or 30s.
But it didn't.
It barely twitched. It closed at 15.84. And high-yield corporate credit, the HYG ETF, was totally flat at 79.53. If the market truly believed the war was starting, credit markets would be seizing up in terror. Why isn't Wall Street panicking about the missiles?
This is exactly why we do this deep dive, because you have to look past the loudest headline. If we connect this to the bigger picture, the data firmly rejects the idea that missiles caused a pure panic sell-off. You nailed it with the HYG. High yield or junk bonds, they're incredibly sensitive to systemic survival. If there's a real crisis, institutions dump those first.
Right.
The fact that HYG was flat tells you credit markets were functioning fine.
So if it wasn't the ballistic missiles that took the Nasdaq down 600 points, what did?
Well, I would argue that the tech drop was far more likely driven by this concept of AI capex as a self-referential valuation loop finally cracking.
Okay, unpack that.
Here is how that loop works, right? The tech sector has been propped up by massive companies buying AI chips from each other to build vast data centers. And this is all under the assumption that there will be endless future demand from everyday consumers and businesses. But then you look at that 8.02 AM data. A 12.4% collapse in housing starts.
Right.
That shows the physical ground-level economy is aggressively cooling down.
So it's like, think of that AI valuation loop almost like a company town. Nvidia sells chips to Microsoft. Microsoft builds data centers hoping startups buy compute, and those startups buy compute using venture capital money. It's a closed circle of spending.
Exactly.
But if the physical economy cools if everyday people stop building houses and stop spending outside money, that external revenue slows down, and the entire circular logic of those sky-high tech multiples starts to fracture.
Perfectly said. The market woke up to the reality that these massive AI infrastructure investments might not survive a broad physical economic slowdown. The missiles in Dubai were the loud distraction, but the cooling physical economy and those hawkish rate pressures we discuss, those were the silent killers of the equity rally today.
That makes total sense. So we saw the collision of a fragile, overvalued tech sector meeting the harsh reality of slowing domestic growth with a side order of geopolitical chaos just to, accelerate the cash raising. So that's the U.S. session in a nutshell. We'll take one more short break, and then we'll dive into the corporate specifics.
Let's do it.
All right, we're back.
So let's look at our corporate events recap and what should we be watching next?
Home Depot is the perfect place to start here. They released their fiscal second quarter earnings today at 6:01 a.m. Eastern Time. Now, on the surface, the numbers look fairly stable. They reported 5.7% year-over-year sales growth, bringing in $47.9 billion. But the devil is always in the details with these reports. Management took the time to explicitly warn that consumer risks are actively building.
And if you're listening to this and wondering how a hardware store impacts your portfolio...
Right, it seems detached.
It does, but it comes down to the health of the average household. What Home Depot is flagging perfectly captures the theme of consumer debt exhaustion bypassing rate cut relief. Meaning even if everyday people are hoping the Fed might eventually ease up on interest rates, it doesn't matter, because their credit cards are already maxed out today and their housing wealth isn't as liquid as it used to be. When a bellwether like Home Depot warns about consumer exhaustion, it is a giant red flashing light for the broader retail and consumer discretionary sectors.
It completely validates the fear we saw in the collapsing housing starts data. But, it wasn't all doom and gloom in the corporate space. We actually had two major updates in tech today that show fundamental progress, despite the index obviously taking a beating. At 12 p.m. Eastern Time, Apple officially resolved its long-standing App Store dispute with the European Union.
Oh, right.
Yeah, starting this October, they are dropping their controversial per-install charges in favor of just a flat 5% commission.
That's a pretty big shift. And earlier in the morning at 4:08 a.m. Eastern Time, S&P officially affirmed Nvidia's AA credit rating. This came right as LG Electronics announced they are actively speeding up a robotics partnership with the chipmaker.
Which is a really crucial detail. It highlights that while the overall tech index was bleeding today due to multiple compression and those macro fears, the underlying fundamental expansion for companies like Nvidia moving beyond just generative AI and into physical robotics and factory automation, it is still aggressively moving forward.
Yeah, the physical rollout is still happening.
It's funny, in a dark way, Home Depot is out here warning us about the consumer as if we needed a hardware store to tell us our net worth is currently under major renovation after today's 600-point Nasdaq drop.
Ouch.
But hey, at least Apple dropped its App Store per install fees today, so, downloading a meditation app to cope with the volatility won't cost you anything extra.
A bit close to the bone, but you're not wrong. And looking ahead, the pressure is really not letting up. Here is what you need to be actively watching over the crucial next 24 hours. First, at 12:01 a.m. Eastern Time tonight, going into Wednesday, we hit the critical deadline for those 50% U.S. tariffs on Canadian imports. We will see if negotiators can pull off a midnight miracle to avoid that margin tax.
Fingers crossed. Second, overnight through Wednesday, monitor any escalation in the Strait of Hormuz or any updates on the UAE-Iran security blockades.
Right.
Third, at 10:30 a.m. Eastern Time on Wednesday, we get the EIA Weekly Petroleum Status Report. That is going to be vital to help us gauge where U.S. crude inventories stand against these very real Hormuz supply risks.
Absolutely. Fourth, Wednesday pre-market. Keep an eye on earnings from Analog Devices, Lowe's, Target, and TJX. Those retailers will basically either confirm or deny Home Depot's warning about the exhausted consumer. And finally, at 2 p.m. Eastern Time Wednesday, we get the highly anticipated release of the FOMC minutes from the July 28 to 29 meeting.
Yeah, every single word of that FOMC release is going to be heavily scrutinized by the market for any clues on inflation and the future policy path, especially in light of that hawkish Wells Fargo projection we talked about.
Yeah.